How does the property market work? There are literally 15,264 towns and suburbs in this country, and that is growing. Every year there are new suburbs. Every year the boundaries of suburbs change. And every suburb is different. They behave differently at the same time. So let me give you an example of how that plays out. I looked at, again, randomly picked a couple of suburbs. And if you have a look, I'm considering Eltham, Elphington and Fairfield. Now, if you have a look, Elphington and Fairfield are just a few kilometres northeast of Melbourne. All right, so if we have a look at Elphington and Fairfield, how have they played out? And I just picked 2 times in the not too distant past to illustrate the point. If you have a look closely and can see that clearly, again, I'll probably need to, in order for me to see that clearly, I'll probably better to lift that up, because as much as I am together, my eyesight's failing as age takes hold. But if we have a look, we see that Elphington, we'll look at houses, and that's the blue line. We look at the blue line, and in Elphington and Fairfield, we'll see that over a period of time, Elphington was remaining flat. So if we take a consideration from January 18 through to April 19, we see Elphington was flat. We look at January from Fairfield through 18 through to April 19, we'll see a slight decline. Point of interest, if we look at the number of sales at the same time over the same period, you'll see Elphington actually dipped and then kicked back up, whereas Fairfield did the complete opposite by growing and then dropping back. So the 2 suburbs over the same period had 2 different outcomes, even though they're in the same postcode. So neighbouring suburbs don't behave the same way. You'll also notice that even the apartment market or unit market did not behave the same way as the housing market. It went in Fairfield, for example, the unit market dipped, then rose, and in Fairfield over the same time, house prices fell. If we have a look then at how that actually played out as an example, if you bought in January 2018, you would, at median price, you bought at 1.749. If you sold in April 19 in Elphington, you sold for 1.725. Now that's a $24,000 loss. Now that would hurt. You go, ouch. But on a $1.749 million property, it's annoying, but not miserable. You know, you can pick yourself up and go on again. However, if you did the same in Fairfield as a neighbouring suburb, and you purchased in January 18 at the median price of 1.492, and you sold in April 19 at 1.150, you made and took a financial hit of in excess of $342,000. More so if you include stamp duties and selling costs and whatever holding costs there were from a negative GID scenario. So that would actually hurt a lot. You would feel that. So the question becomes, how then do we understand each of these suburbs so that we can go, yes, I get it, and I would have picked Elphington over Fairfield, or in fact an entirely different suburb during the same period, so that I'd experience growth as opposed to decline. What do we need to look at? Well, the answer comes down to like any other commodity, supply and demand. Marketing 101. Supply and demand and the relationship between those 2 things determines price. If you have an increase in supply and demand remains constant, then you have more choice for buyers and then more desperation for sellers to drop price in order to make the sale. Flip that around. If you have an increase in demand and a static supply, it means there are more people looking to buy the same product, which means people will pay more in order to secure it and beat the competition. And that's the sort of thing that determines price. In property terms, that refers to listings and sales. Now, as an example, how does this work? How does this play out? If we have a look at Hamilton, and again, I just picked a picked up a coin, tossed it, it landed on Hamilton. I want to look at the relationship between listings and sales. So where do I source this data and what am I actually looking for? So if I look at listings in Hamilton, I go into realestate.com.au. I type into the search bar Hamilton. Now, Hamilton has a variety. There's a Hamilton Victoria, Hamilton in New South Wales, a Hamilton in Queensland, a Hamilton in South Australia, and a Hamilton in WA. And if it works out that you pick the wrong Hamilton, obviously that will confuse you. So you need to make sure you pick the one relative to your state or the state that you're interested in buying into. So let's look at Hamilton, and in this case, Victoria with a postcode 3300. What I don't want to do is select surrounding suburbs. I need to look specifically at those houses available in that suburb and that suburb alone. And what I'm after then, when I look at property type, I'm after houses and townhouses. Now, again, houses and units are different markets, and they're more commonly understood in the broader community, investing community, buyers community as different markets. And because they're different markets, they behave differently within the suburb. So while there are more than 15,264 suburbs in this country, there are actually more than 15,264 markets, because about 5,000 of those suburbs have apartments and units, which are at different markets. So Australia has more than 20,000 individual markets playing out differently at the same time right across the country. And our role is to understand how that works so that we can make a better decision about buying, holding, or selling. So we want to identify the market houses from units. And the way we do that in realestate.com.au is we look up houses, we select houses as a property type, and we select townhouses as a property type. If we're interested in apartments or units, we would look up unit and apartment and villa. And that would allow us to get a full spread of the stock available or the supply of houses on the market in that particular suburb at that particular time or on that day. So by doing that, if I press search, I come up with this. And in Hamilton, as of yesterday, there are 102 properties for sale. So I know there's 102 properties for sale right now in Hamilton. Okay. Now we need to look up the number of sales or the demand to want to buy. Now, while there isn't a specific demand measure, sales is a representation of demand, and it's a relationship between sales and demand that works and sustains. The way we would do this is we would type in Hamilton, and we would pick which state we want the Hamilton in, and let's pick Victoria, and then we click on search. And once we click on search, we find out that there is a suburb profile report for Hamilton that says the median price is 212 and the number of sales is 192. So where we end up then is a relationship of listings to sales of 102 to 192. Now, what does this mean and how can we use this? About 10 years ago, 9 years ago, John Lindemann started a company or started to delve into this. And he'd been working in statistics for a decade or so prior to that and started to come up with a relationship that would work. And one of the most profound things that he came up with was a relationship between listings and sales. He and I got together and started an organization called Property Predictions. And Property Predictions investigated this relationship. And let me explain it, because it is really quite powerful in your ability to read what's happening in a market at any time. And you'll be able to see how this plays out very shortly. What we discovered in Property Predictions was that there was a relationship between properties on the market today and the number of sales over the last 12 months. It is a relationship that has been proven month in, month out, suburb in, suburb out, year after year after year. And the relationship kind of plays like this. If the number of properties on the market today is the same as the number of properties that sold over the last 12 months, we then have a one-to-one relationship, or in fact, a no growth market. Now that is powerful. That is an incredibly powerful insight into being able to read the market. Because we can now play with that. Outside of knowing this is a neutral market, we can now modify the numbers and see how this plays out. What if, for example, there were 25 properties on the market today and there are 100 sales over the last 12 months? Then we'd have a ratio of 1 to 4. And the way we would read that is for every property on the market today, there are 4 people looking to buy it. That implies, and if you think about it, if there are 4 people looking to buy the same property, that implies that there is pressure on price, there is pressure on time, you have limited opportunity to negotiate, and you need to move fairly quickly. You would need to build relationships with real estate agents such that you're top of mind for them to put the better deals forward to you. And you would have to have done all of your due diligence in advance in order to know what to buy and what a good property purchase is. So that's really, really powerful. All right. This is by default then a growth market. There is pressure on price to rise. All right, let's flip that. Let's look at a different ratio. Let's say, for example, there are 100 properties on the market right now, and in the last 12 months, there were 25 properties sold. Now, if we look at that, if it takes a year to sell 25 properties, then there is 4 years supply of houses on the market in that suburb. Now, if that's the case, you have got a lot of pressure on vendors. Vendors will be feeling, I don't want to hold my property on the market for 4 years. I want to sell my property faster than that. I will drop the price in order to be more attractive to buyers. The buyer has the power. The buyer is the ability to go, I don't want that one, I don't want that one, or here's my offer, it's a low offer, take it or leave it because there's plenty of choice for me. And the pressure is on the vendor then to make a decision to accept the lower offer or to move on and wait for longer. So this is what we call, in fact, a declining market. Now, if you look at the various different relationships of numbers between listings and sales, we get a ratio and a range of ratios that actually mean something. And we've discovered in property predictions that if you've got a ratio of 1 to 1, 1 to 2, or 2 to 1, it's pretty much a neutral market. Anything 1 to 2 or 1 to 10 is a seller's market, and we can expect single-digit growth in that sort of market price range, market ratio. If it's 1 to 10 or above, we can expect in excess of 10% growth. Now, there's some power in this, in understanding what's happening in the market in any one time, any one place. We flip that around and we go, well, if it's a 2 to 1 or 4 to 1 ratio, then it's a buyer's market and we can expect single-digit decline. If it's a 4 to 1 or lower, then we can expect a stressed market or where vendors are desperate to sell, or a double-digit decline. Now, if we relate that then to Hamilton, for example, then you can see that our relationship of listings 102 to 192 is about 1 to 1.8, 1.9, which is in fact a no growth or slight marginal growth market. And that then allows us to be able to make a decision about how the market's playing in that particular field. So if we're looking to buy in that area, we know that we've got a little bit of time. We can negotiate. There's still some flexibility on price. There's enough properties on the market for everybody to want to buy one. We're not under a significant amount of pressure, which is brilliant. If you're looking to sell, then you know that, okay, well, I'm not going to get a high demand on price. I'll have to put a fair price on the market and expect to be negotiated a little bit, but price it accordingly in my asking and my marketing. So that's kind of how it plays out, which is really brilliant from a perspective of decision-making for what you want to do with each of the properties that you own or every property that you want to buy. So you now have the ability to read the market anytime, anywhere. Now, here's a point of interest on that. Property Predictions has understood this for more than 10 years. And if you have a look at that, we're able then to take this ratio and the consistency that this ratio applies in any market, any suburb, month in, month out, in, year out. And we've been able to determine what's happening in a market really quite clearly at any one moment. But beyond that, with additional data points and other algorithms, we've been able to forecast where that market is going. Not only that, we've been able to determine the time that it's likely to take before movement occurs and when it's likely to get there, which is really exciting. And we've been accurate in our predictive nature in the market direction of about 90% or more since we started this process back in 2011. And that's on more than 6,231 different examples. So the sample size is large, which is really exciting. Now, here's another point of interest about how this actually helps us understand what's happening across the country. If we look at, say, a city, and then we look at the individual suburbs within that city and make an assessment of where the market is at in each of those suburbs within that city, and we aggregate all of that data so that we're able to then pull together some sort of representation between the relationship of boom suburbs, seller suburbs, neutral buyer and stressed suburbs, we're able to get an idea of what is happening in the city at any one time. So, for example, we might get a suburb that looks like this, a declining market. And the way we'd look at that is we would be able to assess through percentage growth or decline where that city sits as an aggregated amount. So, for example, knowing that a boom suburbs is 10% or more, seller suburbs is 0 to 10% growth. There is no growth in neutral suburbs, a single-digit decline in a buyer's market and double-digit decline in a stressed market. We can see that this is a suburb in decline. And when we aggregate all those percentages together, we can find that we're at about a 4% decline rate per annum right now. Or we might get an image of this sort of nature, where we get growth. We can see that there is a small amount of stressed market, a small amount of buy market, but we get a far greater volume of boom suburbs and a significant presence of single-digit growth suburbs. And we'll be able to identify then that we can see that there will be growth in this city to the tune of about 4% per annum at that time or into the future. And this works for both current market and predicted markets, which is brilliant for our ability to then understand what's going on and to forecast where prices are going with a high degree of accuracy.